Okay, good afternoon, everybody. I appreciate you taking the time to come in and join us here for our webinar. Today, we're going to talk a little bit about how to use our insurance dollars to help with our marketing plan. So for those of you that don't know me, my name is Clint McLaughlin with Midwest Market Management. And once again, I'd like to thank everybody for coming out here today. I'm going to go ahead and move right into the presentation here, just momentarily. If you would give me just 1 second, I'm going to get going here. I do apologize. I'm a little bit clumsy here in the beginning phases, but we're going to get rolling here. So now you should be able to see my screen, and if we give me just 1 second here, get into slideshow mode. Okay, so for those of you that aren't aware of who Midwest Market Management is and what we do, again, my name's Clint McLaughlin, and my partner Stuart Hughes and I are now owners of Midwest Market Management. We purchased Midwest Market Management from my father, Pat McLaughlin. He started Midwest Market Management back in 1998. He had a pretty lengthy career in the elevator business prior to starting Midwest Market Management. Stu was also a grain merchandiser in the area right there around Union, Eldora, Iowa, which is where the Iowa home office is located. On our staff, we also have Rich Berg, also a former grain merchandiser, Brenda Oft. Many of you might know Brenda. She's been with the company for quite some time now. She was also formerly a merchandiser. And newest to our team is Mallory Knapp. And she helps keep the wheels on the bus here as we go. And throughout the seminar here, if you have any, or throughout the webinar, if you do have any questions, there is a box where you can chat your questions, and there's also a question and answer box. Unfortunately, today we're not going to unmute the attendees, so you won't be able to ask your questions directly. So any questions, feel free to ask, and Mallory will make sure that you get your questions answered either at the time of the question or at least later on towards the end, at which point we'll have a little bit more time for question and answer as well. So I'm going to go ahead and dig into the meat of the conversation here today, leveraging subsidized insurance dollars to fund your marketing plan. So today, before we get started, I would encourage everybody to grab a calculator and maybe some scratch paper. I personally do a lot better learning if I just kind of follow along. There is some basic simple math in this agenda here today. I've tried to use a lot of round numbers, so that should help out for those of you that might be a little slower like me doing math in your head. We're going to talk a little bit about PLC and ARC. This is the time of year where people are signing up for which of those they would like to be in. We're going to talk about Supplemental Coverage Option, also known as SCO. That's a crop insurance policy that you can use to increase coverage levels. We're also going to talk about the Enhanced Coverage Option, which is very similar to SCO. It just has a different range of coverage there. And then we're going to talk about the marketing benefits of SCO and ECO and how they relate to your crop insurance and how you can use them as a marketing tool. So we're going to get started here with ARC. That is a policy that you can enroll your farms in, and this policy or ARC, is a program that was developed in 2014 with the Farm Bill. In 2014, when you signed up for the Farm Bill, you had to sign up for ARC or PLC, and then you were locked in for 4 years. Now we can choose each year. So we're just going to go through a quick rundown of how these programs work to help you try to decide what you need to do this year, or if it's really even a relevant, decision at all. So what we're going to look at is the first thing when you're looking at ARC County is you need to determine what's your 5-year average. ARC is a revenue plan, so simple in the simplest terms, it's yield times price is going to give you a revenue, and that revenue is a revenue that's based on the county revenue, and it is going to determine your benchmark. So the first step is to determine what your Olympic average is. Now, the price comes from every year we have a marketing year average price. That essentially is the cash price that the farmer received over the course of the year, tracked by RMA and NAS. And what you have here is 2017-18 marketing year, the 18-19, 19-20. So we got the last 5 years. And when you take an Olympic average, what they do is they throw out the high and the low and they average in between. Now what you're going to notice as this comes up, we see a bunch of 370s in here. So what's the 370 all about? Well, there is a rule that says that the marketing year average price that they use will never be below the PLC reference price, which was 370 on corn. So basically this 336 becomes a 370, the 361 becomes a 370, and the 356 becomes a 370. So at the end of the day, we're going to throw out the $6 price from 21-22. We're going to throw out the 336. You take 370, 370, and 453, and you get a marketing year average price of 398. So here we are significantly below current market value. There is a lag in ARC. Now, seems kind of pointless to even be talking about it now, but down the road, that lag will come back to your favor someday if we go back to lower prices. So once we've determined our price is 398 on corn, we're going to go in, we're going to take the same Olympic average. This is an example of a county yield that we pulled out of an example county in Iowa. Again, we're going to throw out the high and the low. So we're going to throw out the 225 and the 180, and we end up with 190, 200, and 210. This is actually just a random example I made up. It doesn't represent a county at all in Iowa. It's just some random numbers that I made up to come up with some even numbers to make some easy math. So we've got a 200 bushel yield. So now if you want to go through and you want to look at our 5-year Olympic average, I rounded it from 398 to $4 for example purposes. $4 times 200 is going to give us a benchmark revenue of $800. So our deductible built into the ARC County program is 86%. So 800 times 86.86 is $688. That's our net revenue guarantee for the county. Our max payment is 10% of the benchmark. So our benchmark revenue was the $4 times 200. So we'll never get paid more than the $80. So here we're going to assume a marketing year average price of 350. Now, I'm not saying that I believe our marketing year average price is going to be 350 because I believe we'd have a lot of people in the poorhouse if that came along. This is just for examples, and I needed to demonstrate, some sort of a payment. So if we came in at a 350 and the yield was down to 190, if you take your 350 times your 190, you're going to get a true revenue of $665. So our original net revenue guarantee was 668 minus 665. We are going to be short $23. Then they take $23 times 85% base acres. We got a payment of $19.55. There's a variable sequestration number that they also pull out of that. This year, they're anticipating that to be around 6%. So in this scenario, we would have a $18 payment if that were to happen. On soybeans, it's the exact same procedure. The 5-year Olympic average on for the price is $9.67. If we use a 50 bushel yield, we've got a benchmark revenue of 483. Take off our 86%, we're at 415. The max payment would be 48 bucks. And if we were to drop all the way to 920, we'd have a 40-cent loss. We multiply the 40-cent loss times our 50 bushels, and we get actual revenue here of $368. We go through the rest of our calculations, take out the sequestration, again, multiply times our 85% base acres, and we end up with a $38 payment. So it's somewhat similar to just a revenue protection plan in that you have a beginning revenue and an end revenue, and you have a guarantee, a net guarantee for that county. And if the final revenue is below that, it triggers a payment. So our marketing year average price for corn is $3.98. Current December futures are running about $5.95. Beans are at $9.57. Current value is really closer to $13.65. And our wheat is at $5.50. Also, again, significantly less than where our current wheat market is. So that's a little bit of Ark County. PLC is essentially just a put option in that we have a reference price, and if the marketing year average comes in below the reference price, then it triggers payment. We multiply that difference times our PLC yield, which is different for every farm that you have. And then they multiply that through an equation, and they can trigger your payment. So on corn, back in 2014, they set the statutory reference price at $3.70. But they said that in 2018, they changed the farm bill up a bit. And that's when they said, well, we could raise that $3.70 price, and it's either going to be the higher of $3.70 or 85% of the Olympic average, but we're going to cap that price at 115% of the $3.70. So if you take $3.70 times 1.15, you get 4.25. So basically, the price will always, the PLC price will always be between $3.70 and $4.25 on corn, and on beans, it's going to be between $8.40 and $9.66, and that will change every year if 85% of the reference price or 85% of the Olympic average is above either that $3.70 or the $8.40. So we'll look at a few quick examples. If the corn came in at the marketing year average price, or the Olympic average is $4.75 times 85% is $4.03. So the new PLC price would become $4.03. If you had a $5.03 Olympic average and you multiply that times 85%, we come in at $4.28. Well, the rules dictate that the cap would be $4.26. Well, actually $4.25. So we the reference price would be, I believe we've got a typo here, should have been $4.25. Let me double check. 3.7 times 1.115 or 1.15, yeah, 4.25. So the reference price in this example would be 4.25. So here we are for 23-24. The reference price on corn, beans, and wheat is not changed because the Olympic average, 85% of the Olympic average was not more than the statutory reference price. So bottom line, they're way down there where the likelihood of triggering payment is about non-existent. So I got a bean example here. If the reference price was $8.40 and we came in at $8, we got a 40-cent loss. Take that, multiply it times 50 bushel, you got a $20 an acre shortfall, 85% base acres. You're at $17, take off the sequestration, and you'd get a payment just shy of $16 an acre, which clearly in this environment is of zero help. So supplemental coverage option, that is what we're going to get to here in just a second. So before I go into the SCO, I would like to just kind of recap here that with the marketing year average price being so low on Ark County and the reference prices being so low in the PLC, it's virtually impossible for us to be able to trigger a payment in either one. So what you have right now is a lot of producers are asking around, you know, what should we do? Should we be in PLC or Ark County? It would probably, a lot of people are, you know, I've been hearing word that FSA, maybe some other banks, other, you know, risk managers are saying you should go into Ark County. I even saw some of that on the Iowa State site, that Ark County would be the way to go. If all I was looking at was the two programs, I would not disagree. Ark County would probably be a better route to go because there is a yield function to that. And if the yield in the county were to be low enough, you could possibly trigger a payment. But that yield would have to be so incredibly low that it would be almost impossible, because we're still have such low reference prices compared to the prices that we're at now. So if you were to have a county come in, you know, maybe a county that should have started at like a 200 bushel expectation, and you come in at 150 bushels and the final price is $5, they're going to multiply the final yield of 150 times 5. And that is still going to be way above the benchmark revenue, because the benchmark revenue started down there closer to $4. So bottom line is neither one of them are going to pay. So now, in my opinion, the next question that I want to ask is, do I want to take supplemental coverage option on my insurance? Because if you enroll in Ark County, you cannot be signed up for SCO. So to me, this isn't really a question of, do I want to be in Ark County or PLC that I should answer first. It's, should I enroll in SCO? And if I am going to do that, then I want to tell FSA to put me into PLC. So what is supplemental coverage option? It's a policy that you can add on to either your revenue protection or your yield protection program. It is based off of your APH, and it's based off the spring price, and the liability is going to vary depending on what level of coverage you take on your multi-peril. It is a different animal in that it is not triggered. Payment is not triggered based on anything that happens on your farm. It's based on county revenue. And so that's what we're going to get into here for a few minutes now. So if we look at SCO coverage, it's a county-based product, and it's going to kick in at 86%, and it's going to cover down to the level that your multi-peril starts. So if you have a 60% revenue protection plan, SCO is going to start at 86 and it's going to cover down to 60%, which is a 26% window. If you have a 75% policy, it's going to cover an 11% window. And if you select an 85%, that window is just getting much smaller, and it's only going to be a 1% window, and the liability is going to be very small, and the premium is going to be very cheap, but the payment is going to be very limited because there's such a tiny window. ECO works almost identically to SCO. However, it covers from 95 down to 86%. So if you notice that if we had a 95% policy down to 86%, we have a 9% window that it's going to cover across all of our, regardless of what multi-peril level we have. I believe we have a little bit of a typo issue here, but the SCO or the ECO would cover 95% coverage down to 86. You can also purchase it from 90 down to 86%. Generally, when I'm looking at ECO, I prefer to be at the 95% level rather than the 90% level because it does trigger payment sooner. So you won't see me spending a lot of time talking on the 90%. But you know, if anybody ever did have questions on that, I can show you how that works. And we have some tools that can show you why, you know, the 95% is more expensive, but over time it would generally perform better. So what we have here is a little bit of a graph, just kind of help us wrap our mind around what's going on. Now these figures here are multi-peril figures. I believe I'm using a $6 price and a 200 bushel yield, which would be $1,200 worth of expected revenue times 60%. That gives us $720. So our multi-peril is going to cover on the 60% policy is going to give you a $720 guarantee on your farm. The 75% would be $900, and an 85% would give you just over $1,000 worth of coverage. This window right here is what our SCO is, this window here would be our SCO, and that would be from 86 down to our 60% policy is a very large window. So it's going to have $300 worth of coverage. The 75%, which is a very common policy to couple up with a RP75 and SCO, would tack on another $132 on top of our $900 in total liability. And our 85%, again, as I mentioned, would be a very tiny window with a liability. And again, this is a liability, it's not a guarantee, because it's based on county revenue, not based on your farm. But that would be a $12 liability. ECO would come in and at the 95% level would tack on another $108. And that does not change depending on the level of multi-peril coverage you select, because it always would cover from 95 down to 86 and stop. So what I'm going to look at here, we're going to just show a little bit. SCO is a kind of a different animal in that it is a county-based product, but it's also, you know, your APH is also very relevant to the situation. So what happens when you look at SCO, the first thing you got to do is determine what your liability is. And that liability is going to be different for every farmer. As a matter of fact, it's actually different for everybody, for every single unit of corn you have, because every field you have has a different APH. So we're going to look at a farmer that's got a 200 bushel APH. If you take that times a spring price of $6, you end up with $1,200 of expected value. If he chose a 75% product, he's got a 86 down to 75 is 11%. So if you take your calculator and you take 1,200 times your 11%, you end up with $132 liability. Now you could have a farmer on the other side of the county who has a significantly different yield history, or he might be across the road and he just has a different yield history because he hasn't been farming as long, or whatever may be the difference. If he had if he had 150 bushel times the same $6, he's only got $900 worth of expected revenue. You multiply that times your 11%, he's going to have a $99 window, or a $99 liability. Excuse me. If you look at another example where this producer, instead of a 75% policy, he selected a 60% policy. We're going to use the same APH. Notice that the liability is now $312, and the producer with 150 is at $234, which is still significantly larger total liabilities, but that's because we selected a larger window. So what we've done is we've transferred more of the liability off of your personal farm and put the weight into the county product. So now we're going to talk about the indemnity. So now that we've determined what each producer, 4 different producers' liability is, we're going to look at how do you get paid if things do not work out. So what they do is they start out with a 200. We're going to start out with a 200 bushel APH times $6 is our $1,200. That's our expected revenue. Now we're going to go full cycle, full crop year cycle. We're going to find out that the county finally ended up, it only yielded 190 bushels. And the price, the end price is established at the same time that RP ending prices are established, which will be October of this year. We'll know what the final price is. And we're going to say that that came in at $5.25. Which is about 70 cents less than where we are right now. So if you take 190 times 5 1/4, you end up with $997.50. If you take that $997.50 and you divide it by 1,200, you get a county performance of 0.83125. Okay, so now from here, it goes through another series of calculations that I'm not going to bore you to death with, but at the end of the day, it comes up with a county payment factor, assuming that it triggered payment. And in this example, we're going to use a 0.2614. So now what they do is they take that 0.2614 and they go in and they multiply it times your liability. So farmer A had a liability of 132, and if you multiply that times the 0.26, now we've got $34.50. And then they keep doing that down the line across all the farmers in the county that had an SCO policy. So the biggest key here is that you need to understand is either everybody in the county with SCO policy is going to get paid, or nobody's going to get paid. It has nothing to do with the performance on your farm. In this scenario, we showed a payment. A producer could have, in that county, had a 250 bushel yield, and he might not get paid, or I mean, he would still get paid even though he had a great yield, you know, and ended up above his expected revenue. He would still collect on this policy. Likewise, if he had lost his whole crop, it got hailed out, and the rest of the county got a good rain, and we ended up with this scenario, he would only collect $34 of his, say, $132 liability. So his multi-peril product would have to pay for the damage that was done on his own private personal farm. So the key here is everybody gets paid or nobody gets paid. How much you get paid is dependent upon your APH and your own personal liability. ECO works the same way. it just triggers significantly faster because you have a 95% revenue threshold instead of an 86% threshold. So I'm going to kind of, this is basically the same numbers. The concept is going to be the same. It just triggers before the SCO does. And in fact, that brings me to another point, is that your SCO product can't pay until ECO has paid out in full, because of the nature that it covers from 95 to 86. Then once that $108 liability, per our example, the liability is 108. Once that's been maxed out and you get to say, 80% of the county revenue was achieved, you're now dipping into your SCO. So I'm going to talk a little bit here about leveraging subsidized dollars to help, insurance dollars to help fund your marketing plan. And there's always a lot of questions about how does my insurance relate to my marketing, and how can I use insurance to help provide a safety net for my marketing plan. So what you see here is we got a $6 spring price. Here in Wisconsin, it's very common for us to be using a 75% policy, just due to the nature of our premiums here. A lot of producers, I know we've got some producers from Iowa and Wisconsin on there. Our Iowa producers, it's not uncommon for them to be at 80 or 85%, just due to the fact that they're rated differently than we are here in Wisconsin. But if you have a $6 spring price at 75%, now I'm going to assume that we have no yield loss. I'm just looking at the price functionality of this, the price portion of this revenue product. Assuming we end up at the end of the year with no yield loss, if we have a $6 price at 75% policy, we're not going to start triggering payment until we get down to $4.50 at our harvest price. So we have now lost, if you take, a 200 bushel yield times our, roughly $1.50, we've lost $300 an acre in revenue, and we're just starting to get paid. Now, to me, that doesn't really offer a lot of marketing help. Okay. If I go in and I tack on an SCO policy, and I assume no yield loss in the county and no yield loss on my home farm, it's starting to kick in at $5.16. Now, that's starting to get a little bit better. Okay, so I mean, we're at least holding on to $5, and that's a far cry better, worse, or far cry better than what could happen in if we were to just really have a tremendous yield this year here in the US, and a few other things go wrong in terms of, some additional demand destruction, you at least have a safety net here at 5.16. If you were to buy an ECO policy at 90%, assuming no yield loss, we're going to kick in here at $5.40. Okay, so now we're at $5.95 currently. We basically have a 50-cent deductible here. We can lose 50 cents before we're going to start kicking in our own insurance. Now you're starting to actually get my attention, and you're starting to take what was originally just a 75% yield and revenue, loss policy, and now you're starting to transform this into a little bit more of a marketing plan. And if you take your $6, if we were to have a $6 spring price times 95 cents, At 570, it's starting to kick in. That is 30 cents below where we are today. Now, we can lose 30 cents, I mean, in a day in corn. Certainly we can lose 30 cents by fall. So now I've actually taken what, in my opinion, was pretty much a very low, keep me from going to the poorhouse insurance policy to I actually have the base of a marketing plan now. And so now, once I get my insurance signed up and I know where my coverage is, now I have a little bit more confidence to sit and wait and try to get a better price for my grain. I can back off of my forward sales here a little bit and wait for a time where maybe we could rally this corn market back up above $6, maybe get $6.50 for our corn. And if I'm wrong while I'm waiting and this whole price comes unglued, and I get caught with nothing sold, I have something now that is going to keep me in business, and it's going to, it's the base of my marketing plan altogether. And the other thing I'd like to point out is these policies, these premiums are affordable because of the fact that they're subsidized anywhere from 38 to some of these policies are paying 65% of the bill. When you get shown the $20 bill, that's only 35% of the actual premium on some of these policies, depending on the coverage levels. So they are very heavily subsidized, and that's why over time, these policies actually can pay you back more than you pay for them. They may not pay back more than what the insurance company collected, because the insurance company is collecting your dollars and the subsidized dollars. So we all know that an insurance company is not in the game to lose money, but they can pay you back more than you pay for them over time because of that big subsidy. So everybody's going to want to know what the cost of these are. These are just some very generic quotes that I've run. Both are based on enterprise units. In Wisconsin, it's not uncommon for us to pay $23 for a 75% policy. If you put SCO on it, that's $14, and ECO would be another $20. So if you stacked all three together, we would be looking at about $57 an acre. In Iowa, if you did that exact same thing, you would be at about $65 an acre. Now, I know there might be some of my Iowa producers that are going, oh, wow, that looks attractive, $65 an acre. Well, bear in mind, we've only got you on a 75% policy here. I'm using these as examples. I'm not saying this is what I necessarily would endorse. Everybody's situation is different. What we have found in Iowa is that our hail and wind rates have gotten so incredibly expensive, and we lose so many bushels over the years due to hail and wind, particularly wind, that we're finding it often better to increase our coverage levels to 80 and 85% and save the money to use. We're going to spend more doing that, but then that allows us to have better coverage and not buy as much hail insurance. So again, these premiums, I'm not saying this is the product that I would use. I'd be happy to meet with anybody and go through a lot more in-depth questions about your farm and what you're doing and what your goals are before I'd make a formal recommendation. But at $57 an acre, if you on 165 bushels, that's 34 cents a bushel. I was looking today, and I believe at the money December corn put options are currently trading 48 cents a bushel. So if you take 48 cents a bushel, you said, you know what, I don't want to spend this much on insurance, I'm just going to buy myself some puts. and you go spend 48 cents a bushel and you multiply that times your 165, you're going to spend $79.20 an acre, and you have no yield protection with that. In 2012, had you taken that program, a lot of guys would have lost all of the money on their puts, and then the corn, price went through the roof, and they didn't have the yield, and they'd have been in a pretty hot seat. The other thing I like to point out to guys, I have guys that come in this office and meet with me for the first time, and I'm endorsing looking at these as a marketing tool, and they're like, holy cow, I'm going to spend $57 an acre. That's double what they're used to spending. Well, my point to them is, you're not going to walk out of here and not buy anything. I mean, there's not many producers out there that are leveraged to a position where they want to go or can go with no crop insurance. It's hard to recover from zero. So most of these guys are going to spend the $23 anyways. So really, the increase in what we're doing to take it from, in what in my opinion was simply a disaster revenue insurance program, up to something that I could actually confidently call a marketing plan, I'm only going to spend 21 cents a bushel, because the first $23 of that I'm going to have anyway. Same thing in Iowa. If you take this across average APH at 238 bushels, you're looking at spending somewhere between 22 and 26 cents an acre or a bushel, which is in my opinion a pretty affordable approach to getting probably the best safety net underneath you that you're going to get. So that is in a nutshell how SCO and ECO works. I realize it's a lot of numbers, and there's a lot to digest. There's also a lot that a guy should really investigate. How do I compare to the county? You'll hear that a lot when you're talking about county products. We have some tools available to us that I built. They're personal and exclusive to us, that allows us to go into any county pretty much in the country, for sure in Wisconsin and Iowa and the surrounding states, and we can pull it up your county, and we can show you what the county average has been over the past 10 years. We can show you what the expected county yield is for this year. We can plug in your own yields so that we can see how that product, how all these products would have performed next to each other on their own farms. Here's an example of Hardin County, Iowa. So here we have the last 10 years of county history. Now, keep in mind, we don't know what the county yield was from 2022. We will not know that number until June. So that is a problem. One downside of SCO and ECO is that if you get paid on them, you will not get paid until the following June, because we have to wait for the RMA to get all the yield data that you turn in for your production reports to your crop agent. They come in and they grab those yields, and that's how they determine the county yield. And over here, you have what the expected county yield was then and what it is now. And as you can see, it's been trending higher over the years. Over here, we would also put in your grower yields, and now we could put the premiums down here, and we would see how all these products have performed, not just SCO and ECO, RP, YP, RPHPE, area revenue protection, all the federal subsidized programs are in our tools. And then we can go into a simulation mode where we can play with prices and yields and show you how they would perform on a yearly basis as well. So I guess we are moving along here. It's 3:45. I was hoping to keep this to 30 to 45 minutes. So we're getting near the end. So I guess at this point in time,
we do have a few questions that have come in.
Okay.
The first one is SCO a new product, and is there a cap on how much SCO can pay?
SCO is not new. It's kind of newly being utilized. It was new in 2014, but for those of you that recall, when the Farm Bill changed in 2014, they laid out SCO, but at that point in time, you had to sign up for either PLC or ARC for 6 years. And once you, for 4 years, excuse me. And so at that given point in time, it was a given that Ark County was going to be paying. So everybody signed up for Ark County, which then made you ineligible to sign up for SCO. So nobody used it for the first 4 years. And then after that, it just kind of faded out. Nobody really thought about it. And so it's being utilized a lot more now than it used to be.
The second part of that question is there a cap on how much SCO can pay?
Well, that's right. If the price goes down, the cap on how much it can pay is the liability that I showed you how to calculate. So like on the 75% policies here in Wisconsin, it was about $132. So if the price is lower, then it's not going to pay you more than that liability. It can pay you more than that liability, though, if the price is higher. And the way that works, the only way it can pay you if the price is higher is if the county experiences yield loss. And to put it into a drastic, extreme, if the county came in at 0 bushels, or I say 100 bushels, and then the fall price was, $8, it's going to owe you your lost bushels. So maybe the county lost 60 bushels. It would multiply that times that higher fall price. So like your revenue policy, it could actually be more than your guarantee or your liability, however you want to look at it.
We have another question. How do you know if SCO or ECO is going to pay on any given year?
Well, if you were signed up for it, I would assume your agent would probably be calling and giving you a heads up that, hey, we got some claims coming through. Otherwise, it just generally automatically sets or generates the claim on its own. That, again, like I mentioned, one of the downsides of it is you don't get paid until June the following year, because producers turn their yields into their agents. The agents then submit it to the AIPs, and then once the AIPs have it all in, RMA comes into the back door of the software programs, and they pull out all the producers in, say, Outagamie County, and they figure out what the average was that everybody turned in. And so that's how they know if a payment was triggered, because that's the last step of the equation is what was the county yield.
And we have one final question, unless any more come through. Can you buy ECO and not buy SCO?
Yes, you can. It is kind of a stair stack building program where you start with your multi-peril, and then if you choose to, your SCO would cover from, say 75% up to 86, and then ECO would kick in from 86 to 95. You can skip the SCO and just stack your coverage in that top portion. You would just have a gap in coverage. But a lot of guys will do that if they want, because it's the most shallow loss, it's the most shallow loss program you can get in terms of crop insurance right now at that 95%. So, they want it to kick in first, and it's the first one to pay. So that's what they buy, and they leave the SCO off. So yes, you can.
That's all I have for questions that have come in.
Okay. Sounds good. Well, I'd like to thank everybody for coming out here today. I greatly appreciate it. We're looking forward to doing some more of these style events. It's quite a snowy afternoon here in Outagamie County, Wisconsin. So it's a good day to learn something from a webinar rather than being out and about. So appreciate you taking the time, and we'll talk to you soon.